Hello, everyone. I am hoping that you will be able to hear me okay. Can you let me know in the chat if you can? Amazing. Barsha, thank you. Fabulous. So I am so delighted to be here. I know the session is starting in 2 minutes, so I'll take just a moment while that gets started. Always want to make sure that we're on time. Natalia, thank you. Fabulous. So I'm super excited to be here today. I'm going to be sharing lots of tips on mastering your finances, and more importantly, how to reduce your stress that way. We'll get started in just 1 minute. I certainly encourage you, if you can, any questions you have, you're welcome to pop them in the chat. Clarice, thank you. We'll get started in just 1 minute. Fabulous. Okay, well, welcome everyone. So glad to have you here today. So, as I mentioned, my name is Brooke Gordon, and I am so delighted to be here today. You may have heard just a few minutes ago Franca talking about the BDC. Well, my role there is to support women entrepreneurs just like yourself to grow and scale your business. And I am quite excited to share that this past week, I actually got a new title. So I'm now the Regional Manager for Client Diversity to reflect that the scope has been expanded to support more than just women, which has been my focus for the past 1.5 years. And instead, we're just continuing to our commitment to support Canada's diverse entrepreneurs. So women, Black, Indigenous, LGBTQ, veterans, newcomers, youth, helping their businesses and our economy in Canada thrive. So I'm incredibly excited to be here with each of you. I'm so honored to be talking about one of my favorite subjects, which is finances. And I'm joined today by my colleagues that you've already had a chance to hear and meet previously, which were from FedDev and also from OSME. So thank you so much to Dolores and Franca. So over the past year, we have collectively experienced an unparalleled situation, and the business owners that I speak to, they're preparing for a new reality. That's why I'm delighted to talk to you today about concrete approaches of how to manage your business. Now, at BDC, we know that poor financial management is one of the leading causes of business failures, and that's never been truer than it is in these difficult times. Now, a survey of Canadian small business owners showed that almost all of them believe that they possess an average or an above advanced understanding of financial management in principle, but only 7% were actually able to correctly answer most of the financial questions in an accompanying study. So what that said to me is that the understanding the concept is much easier than actually putting it into practice. Now, you'll be hearing me talk about working capital, cash flow. I'm really happy to explain any of those terms. Just drop a note in the chat. But what those actually sound like to me are, my business is doing well, but there's never enough cash. My sales are up, but my profits are decreasing, and I don't understand why. I don't understand what my accountant's talking about. And the one that actually breaks my heart is when business owners tell me, I just file my annual reports. I drop my receipts off, and I trust that my accountant will tell me if something's wrong. Now, before I get started, can I get a yes or a no in the chat? Do any of these statements ring true with you? No, yes, no. Okay, a good mix. Well, for me, I come from consulting and operations. Oh, heck yes. Okay, getting there. So I come from a consulting and operations background, and I found the terms really overwhelming when I first started as a development banker. Now, BDC has some fabulous resources. I wanted to introduce you to our first one, which has over 300 terms in our glossary. It's designed to help you better understand any of the terminology that you might come across while working either running your business, dealing with your accountant, or dealing with your bank. Now, if you're like many other entrepreneurs, you may have only a vague idea of what's happening in your company's finances. You might be relying on that kind of guesstimation, that intuition. And I'm just going to be really blunt and I'm going to say it out loud. It's just not good enough, not right now. You need to have a really clear picture of what's going on with your company finances. That way you can act on information and make, whether it's improvements or to pivot with confidence. So you want to go through that process. You want to be able to finance your growth to enable more growth. And I'm going to get more into that a little bit later on. But first, we're going to start of what I mean by having a clear understanding of where you are financially and where you want to go. Now, the first step to improving your financial management is to plan for the coming months. And you can do this by making financial projections. It's your best estimate of how money is going to flow in and out of your business. And your financial projections can help you anticipate peaks and valleys in your cash flow. And that allows you to plan for times when you know that cash is going to be tight, but also for those times when maybe you want to take on a new project, like buying a piece of equipment, or as Janelle said this morning, maybe redoing your website. Now, once you've made those estimates, then you want to start tracking your progress against them as the weeks unfold and adjust as you go. Because planning gives you more control, and that is going to give you the peace of mind that you need to run your business. Now, managing your cash is your most important job as an entrepreneur. You're going to hear lots of other advice, but I'm going to say that your company's survival depends on it. Even profitable businesses or fast-growing companies can actually go out of business because they run into a serious cash crunch. And so that's why we created a cash flow planner. And at the end, I'm going to drop a whole bunch of links into the chat for you. Now, you can do this with a software tool or the spreadsheet that I'm going to show you. And what the whole purpose is to anticipate your cash inflows and outflows in the coming week. Now, once you've created those projections, you actually want to track your cash, what has actually come in and what's actually gone out. And this type of planner allows you to anticipate when payments from customers are expected versus when payments from suppliers must be made. And that cash gap in between, that's what working capital is needed for. So you might be looking to forecast times of tight cash flow, but again, you also want to plan for your projects and your financing needs, and you can do all of this relatively simply. The planner will also stay on top of problems. You can make adjustments, and you can actually make really smart decisions, like when to actually hold a sale. Why would you be holding the sale? When you might delay discretionary payments. Now, our clients tell us this significantly reduces their stress because they have a much better handle of what's happening in their business. That whole thing about knowing your numbers. So cash flow, it is often referred to as the lifeblood of your business. It's the money that literally, I said it again, flows in and out, but over a specific period of time. So it's what you collect from customers on the one hand, and then it's the money you owe out, maybe to suppliers, to purchase inventory, but it's more than a budget. Because a budget takes your total revenues, expenses, and it divides it usually equally over 12. So seasonality is a serious consideration that's captured in a cash flow planner, but not in a budget. Now, I mentioned before that even fast-growing companies can face a serious cash flow, and this is what happens when the money going out is faster than what's coming in from customers. So I wanted to share a quick story with you. There's a woman that I had the absolute pleasure of meeting. I was on her podcast. Her name's Lori Kennedy, and she shared a story that honestly, I was sitting I'm here talking to her and my heart is gripped. I'm like sitting on the edge of my seat. I was like, oh my gosh, I can't believe this happened. So I need to tell you the story. I'm not going to tell it as good as she does, but I'm going to tell you the story. So she had started Facebook ad campaign. Amazing. We all want to know about how to do that, and we all want it to be successful. And hers was. In fact, hers was so successful that the ads, she just kept topping out the budget week after week, day after day. It was amazing. It was really getting a great response. She was so excited. Now, what she didn't do is she didn't mention to her accountant or her bookkeeper that this was happening. Why would she? This was a marketing project. And she had her brand new signature program all lined up, ready to go. She had her funnel and pipeline all tested. It's all coming in. The leads are coming in. She's seeing the conversions. It's happening. She's so excited. And payroll's coming up. Okay, well, she's looking in the bank account. I got plenty of money in the bank account, except that Facebook was tied directly to her bank account. And so that money that she saw in the one day was just gone, and payroll was coming up. And she literally thought she was going to be sick. She did make it, I'll tell you now, so your stress isn't where mine was. But it really, she said there's a couple things that really took away. One of them was your cash. Also, there's ways to protect it. Now her Facebook ads come out on a credit card, which she has control over when that gets paid. And don't silo within the business. Finance touches every single aspect of the business. So that's why I want to show you this tool so that you can avoid this in your business. So here's an example of a cash flow planner. And we use this spreadsheet to project, itemized cash flows from week to week. It's called a rolling cash flow forecast. It needs to be updated at the beginning and at the end of each week. So for smaller businesses like yourselves, definitely recommend a 13-week period. So a little bit more than, I think that would be 3 months. Now, larger companies with stable cash flows, we actually recommend to do it monthly. So it's pretty straightforward. You complete the table. So first you put in all the things that you expect to have as money, whether it's receivables, cash sales. In this case that I'm showing you, there's a loan, and you can see that in week 2, she's got $10,000 loan coming on. But if she was going by, this business owner was going by the amount of cash in the bank at any given time, you can see in week 2, hey, she's doing really well. Why not start thinking about all these other kinds of things that she could be purchasing? But that's not the case, because she's making a purchase, right? So she's planning on buying a forklift for her manufacturing company, and that's going to add to her account payable, in this case, $11,700. So she'll also be paying more principal and interest. So you can see that on the financing line, it started out as $200. She already obviously had a loan in play, and now she's got this additional loan that's happening. And so she's got additional principal and interest payments. So at the end of this period, she actually ends up with a cash balance of $6,950. So the next step would then to be, here's your projections, here's what you think is going to happen, but then to actually come in and track your actual results and compare them to your projections. Because what this does is it helps to reinforce and build your intuition. And also it gives you a chance to start really forecasting and seeing, okay, what's happening? What do I need to do? Can I make, was there a variation from what I thought? Is there a deviation from what I planned? How am I going to fix it? As opposed to at the end of the year, collecting all your receipts, dropping them off with your accountant and saying, oh, what's going on? I didn't know there was a problem in my company. Now, a little bit later in the presentation, I'm going to give you some tips on how your company can actually improve its cash flow. But before I get there, sometimes we talk about ratios. They're helpful for analyzing the financial health of the company. So comparing performance to other businesses, this is one of the ways that bankers and investors look at making their decisions for lending. It's also used by business owners, though, to assess if they've accumulated too much debt, stockpiled too much inventory, or if they're not collecting receivables fast enough. So in other words, it's a way to help you make smart decisions about money. And that's why they're often included in financial dashboards and management reports. So they fall into just 4 basic categories: profitability, liquidity, leverage, efficiency. I'm not going to get into them today, but this is a good conversation to have with your accountant or your bookkeeper, because you really want to make sure that you're choosing the 3 that makes the most sense for your business, something you can track every week, something that's easy for you to calculate that you can do yourself. And I often hear, oh, Brooke, but I don't have time for all of this. Well, you don't have time not to. I'm just going to say that. You don't have time not to. This is a great excuse at the end of the week to just wind down with a beverage of your choice, cup of tea, whatever it is, and just go through and know where you stand. And these financial ratios can help give you that snapshot picture. So now that you have some tools to monitor your company's performance, you can use them to make your company stronger. I mentioned earlier I want to give you some tips, so let's get into those now. The first one, get paid faster. Hello. So for many women, payment can be at the end of an appointment. Maybe if they have I love that, financials over wine. Could be bad. I don't know. I'm not going to make a comment, Candace. I hear you though. But one of the things that we do find is that it's really about making sure that you are getting paid and really thinking about, is there a way to have those payments come in on a regular basis rather than chasing one-time clients? So here we get into the concept of the signature program or the subscription model, the membership model, things where you can actually start to have a regular cash flow from the same person. You really want to get tough on deadbeats. And what I mean by that is aggressively following up on late payments. So one way to encourage your customers to pay on time is to charge late fees. But late fees can be really hard to implement in practice because there's not really any reason for them to pay other than what the original bill was if they do actually pay. So consider asking for a partial or full payment up front. That's one way to do it. The other thing to consider is to have milestone payments. So Candace, this is a great question. How do you deal with larger companies that refuse to do things in the normal timeframes? I'm going to get you to clarify that question in terms of normal timeframes and what you mean by that. If it's whether or not they're asking for extended payment terms or if they're asking for different, normally do 30 days. Okay, so I'll get into that in just a second because that's a great question. But one of the other ways to do that is instead of paying late fees is for actually charging a premium on payment plans. So asking for that partial or full payment upfront initially, that's one way to do it. And then charging a premium if someone needs to have it broken out into a payment plan. Also, customers who have been paying late on a previous orders, when they come back, definitely ask for a partial or full payment upfront or just decline the opportunity because you really want to always consider firing your problem customers. So knowing your ideal customer is a critical part of your marketing plan. Those are the people you want to sell to. It's not the chronic late payers. It's not those who complain excessively. It's not those who return a lot of merchandise. Because while that may not physically cost you that much money, it does because it's draining the attention of you and your employees from being profitable. So holding on to cash longer is just as important as getting paid faster because both mean cash in your business. So focusing on fixed costs like rent, utilities, insurance, subscriptions, always be testing to make sure you're paying fair market value, or if you can get a better cost overall. Keep in mind, they may also have payment plans with premiums, so you actually might be paying a premium to them. So definitely explore your options if it's something that's essential to your business. So I'll give you a quick example. Today we're using Hopin. There's other platforms as well. Sometimes I'll have an annual fee that's slightly reduced, but that may actually not be the best decision for your business because you may not have the cash to do that. It actually make more sense to pay month by month as opposed to paying all up front. The other tip I want to give you is to give incentives to your staff and contractors. You want them to feel accountable for the costs in their area of responsibility. So consider things like appropriate rewards for employees who find ways to reduce expenses. And I heard a great tip from Manjeet Minhas. It's part of her signature talk. And she insists that negotiation skills are part of her team's professional development plans. And I just love that tip. So I wanted to pass that one on to you. So holding on to too much inventory can also take a bite out of your cash flow. However, you don't want to keep so little inventory that you run out of material and can't deliver on time. So finding the right balance, that's what inventory optimization is. Now today, it's not going to really the focus of what we're talking about, and it is a complex topic, but I do want to give you a couple of ideas. So here's some things to consider. Plan for changes in demand and volatility. If your company has seasonal highs and lows in demand, then modulate your inventory levels to meet that demand cycle. Then optimize for different customers. So consider that different customers have different expectations in terms of service levels and lead times. It's important to be upfront about how you manage your inventory and your lead time requirements. You may have some people who don't necessarily need it immediately and may be willing to take a delayed payment or take some kind of additional terms in order to buy you more time around your inventory workflow and lead time. You want to make sure you've built really strong relationships with your suppliers, because the goal there is to make sure that you can rely on them to deliver on time, and that hopefully they'll go the extra mile to meet a tight deadline for your schedule. And then consider technology. So think about buying inventory management software if this is a huge part of your business. They have tools to help with forecast demand, to compress your order to delivery cycle, and to optimize your buffer stock levels, which are the amounts that you keep always in stock regardless. And then drop your losing products. Now, this one is a difficult one for some women entrepreneurs that I've met. You want to speed up your inventory turnover by analyzing each product line and let go of the ones that lose money. You have to remember that it costs money to pay for space, to store and count stale inventory. And if it's not selling, there's actually having a cost to sitting there. The flip side to that, of course, is that this was part of our creativity and something that we created. And so it can be hard to let go. And I acknowledge that, but it's still an important decision to at least know that you're making the decision rationally, not just emotionally. Now, let's talk about financing. And Candice, I'm going to come back to your comment in just a few moments. Let's say you've got plans to expand your business. You want to buy a new piece of equipment. You want to redesign your website. Many business owners make the mistake of paying for growth projects out of everyday cash instead of seeking a business loan. Now, that approach can put a lot of stress on your cash flow. So often the better choice is to actually get a loan. Now, BDC, we are what's called a project-based lender. So here you can see an illustration of the hidden costs of purchasing real estate. To give another example, I've met a few estheticians the past couple of weeks who wanted to start a medical beauty clinic. One in particular really jumped out at me. She's got a nursing background and she wanted to buy a laser for treatment. And the conversation we were having, she was debating between the cost to lease or buy. Now, the questions that I was asking her, though, were about all the other costs. They're going to be setup expenses like electrical work to accommodate the equipment, health and safety considerations, additional insurance, training, maintenance, not to mention the hit on her cash flow while she's actually taking the time to bring the equipment into full service. Again, we know from the research that women entrepreneurs tend to be more conservative when it comes to borrowing. So our advice is to develop a cash flow forecast for each individual project, one that includes both the optimistic scenario, not just the pessimistic one, and then borrow enough money to ensure you can cover your project costs, including contingencies, and especially the working capital required to bring your project to completion. And the reason why that's so important is because it's not till the project is complete and earning revenue that you can not only pay back the loan, but have all that extra money for you as well. Now, when I speak to business women owners, I think there's a real misconception between the use of debt and equity to finance their business. So if it's okay with you, I want to take just a quick moment to explain the difference between them. Now, we're most familiar with debt. From a consumer perspective, you have a line of credit, you have overdraft at the bank. Those are good for short-term purchases. Mortgage, on the other hand, well, we're now all in each other's homes. This is my home office. And what we find is that a mortgage on a property can have consistent payments over a longer period of time. There's also financing through big box stores or a department store credit card. That happens to be my personal favorite because I can store points and buy new clothes, just my thing. Now, as a business, you have access to the same type of debt and a few more. Now, a term loan works very similar to a mortgage. It's typically for a project or equipment, maybe in the, I'll say, 7-year range, sometimes upwards to 25 years. Then there's trade credit, and that's what, Candice, you were talking about. So that allows you to delay payment for 30 or 60 days on goods. The flip side to that is that someone might be taking credit from you by delaying payment for 30 or 60 days. Larger companies sometimes take longer to go through all of their processes. 30 days is actually quite a quick turnaround. Most corporations and some larger institutions, I used to work for a university, 60 days was, you were doing well if we could pay you within 60 days, the number of approvals that it needs to go through in the total process. So it's something to consider. Now, family and friends, they may offer you money as a loan. So to avoid misunderstanding, it's really important to have a formal written agreement specifying the terms of the loan, the repayment requirements, and the terms of interest. Equity, this is different. This is an exchange of funds for shares in the company or maybe as a partner. You sometimes hear the term venture capital or VC, angel investing, a silent partner. There's no repayment plan. Instead, these are people who've taken a risk that the business is going to be successful. Now, equity financing, it can also come from friends and family who want to be part of your business. So again, this is one of those times where you really want to be sure you're seeking legal advice to draw up an agreement. Both debt and equity have advantages and disadvantages. One major benefit that's frequently overlooked is that business debt creates tax deductions. So this may not have a very big impact in the early stages of your business, but it can make a big difference in net profits as you continue to grow your revenues. And the most significant disadvantage of using debt, well, it's the obvious one. It requires repayment no matter how well you're doing or not. Now, to avoid this, I've met many women who said to me, well, I cashed in my RRSPs or I got a second mortgage on my home. And these are personal assets that they've transferred to the business as equity. And this is the scenario I just briefly want to talk about. In the case of debt, a lender wants to minimize their risk in the event that you're unable to repay. They're going to evaluate the assets you're willing to pledge as collateral to secure a loan. This is where the concept of leverage comes in. So those RRSPs, that home equity, that could have been used to borrow against, in which case you get to keep the cash and also you get the savings, keep the savings that you had instead of just the cash. So I'll say that one more time because it sounds pretty awesome, because it kind of is. You get to keep all of the savings that you've worked really hard on, and you get to have the money that you need to grow your business that you're borrowing instead of just collapsing everything and just having the cash. Now, from a lender's perspective, personal investments are sometimes not recorded as shareholder equity on the financial statements, so they're not taken into consideration. Also, cashing in personal savings, this could indicate a risk of poor financial management or insufficient cash flow. These can be red flags for a banker. And once you cash in your savings or equity on your home, it cannot be used as collateral against the loan. So you actually may not be able to borrow the amount you need on a future project. Now, I've been talking about some of the challenges that women women go through when they want to obtain financing. And as entrepreneurs, I want to acknowledge that you have an intuitive idea of what will succeed in your business. Your intuition, it comes from years of experience that you have in the business. And as a banker, well, we have a more analytical view of your business and the projects that you want to take on. So we want to compare your business and its projects with all the other clients that we're managing. And you might have the impression that we overestimate risk. It's important to remember that there isn't one way that's better than the other. They're just different ways, complementary ways of looking at your business, different ways of thinking. I'm going to share a few tips so that you can convince your banker that financing your business and your projects is the right choice. All right, here we go. Biggest question your banker wants to know is, are you an acceptable risk? So bankers, they're just like other business people. We're always on the lookout for new clients, but we can't remain in business if we don't sell our product. And for a bank, that product happens to be money. But bankers also want to minimize their risk. So to convince the lender, you will need to satisfy what we call the 5 C's of lending. These are the criteria that any lender will be looking at when assessing you and your business. And I just want to be clear, while BDC uses the 5 C's, many of my colleagues at other banks have very similar models. They've got just slightly different naming, but we all look at the same thing. Any of the charter banks look at these same things. Character. We want to know if you have the management skills, experience, and track record to deliver on your business plan. Capacity. Do you have the ability to repay the loan? Particularly, banks are going to be looking at both your track record in handling credit and your company's cash flow. Capital. A lender will use various ratios, we talked about those earlier, to basically evaluate your current and past financial performance. Conditions. As a lender, we want to determine the terms and conditions of your loan are designed to keep our risk at an acceptable level through the whole repayment period. So we're future forecasting. And then collateral is the last one. Again, I talked about this. The lender will evaluate the assets that you're willing to pledge as collateral to secure the loan in the event that you're unable to repay. Now, many entrepreneurs believe that a business plan is a tool that's only required by bankers when the business is starting up. But I'm going to say every project that you take on should include a business plan, whether or not it's shared with a banker, because it really helps you as a business owner ensure that your decisions to invest are informed, because it's based on an analysis of the market, the competition, market trends, opportunities, risks, not just your intuition. And when it's shared with the banker, well, the business plan becomes a document for discussion of what's practical and feasible. Your banker will also have insights based on their experience with other clients, so they're a great resource for you as well. Now, what should you include in your business plan? Well, a description, history of your business, an overview of your team, so the roles, experiences, competencies, competitor overview, and what we call a SWOT analysis. So that's strengths, weaknesses, opportunities, and threats. Your financial forecast for the next 2 years at a high level, your sales plan that aligns to that projected income, and then a marketing strategy to support it. So those three things all fit together: your financial forecast, your sales plan aligned to that projected income, and then a marketing strategy that shows how you're going to support the sales. And then finally, your production and HR plans to fulfill all those sales. I'd also encourage you to consider a market study, articles that back up your conclusions, the biographies of your team, client testimonials, and expect that there's going to be risks. So write them down, map out ideas for how you'll address them. This is a great conversation to have with a banker. Now, Dwania, I know you're going to be recording this, and I'm delighted because I know there's a ton of information in there already. My second tip, though, is to know what you want. So shop around from various lenders. Look at the loan conditions. Find out if there are account managers that specialize in your industry or in the type of equipment or property that you're trying to finance. You want to ask your business contacts about their experiences. Get a referral for someone that they trust. Define your objectives, so know what your needs are and know what your limits are. So you want to make sure that you're realistic about the total cost of the project. We talked about that earlier. And do your homework. Know if you actually can repay the loan and what you have to offer as collateral for the financing. And there's tons of different ways that you can calculate that. Lots of free tools. BDC has many. So some questions for you to ask. What is the area of expertise of your banker? What loan term is the lender willing to offer? What percentage of the cost of your asset is your lender willing to finance? What is the lender's flexibility on repayments? And what, if any, personal guarantees are being asked from you in the case of default? On your side, it's also important to know what terms and conditions to expect when you apply for a loan. Now, we find that entrepreneurs are very focused on the interest rate, but that's only one element of the equation. And you can actually risk losing flexibility if you put too much emphasis on the interest rate. So compare the benefits of the project you want with the cost of financing. This is your return on investment or your ROI, relative to the interest rates. That will give you better perspective. Also, don't forget that interest rates are tax deductible. Consider the length of the loan. You have to account for your ability to pay back the loan, but also the useful life of the asset you're trying to finance. So you want to maximize the length of your payment to gain flexibility, protect your cash flow, but at the same time keep a financial cushion. So it's often easier to speed up your repayment in the future than it is to extend your payments in the case of an unseen circumstances. Collateral. This is important. We talked about this. What do you have to offer as collateral for the financing? Your personal guarantee will show your banker that you're sharing their risk. Tangible assets like equipment or a building can lower the cost of borrowing and lengthen the payback period. But a business without tangible assets can still obtain financing if they have good cash flow. That's one of the reasons why I've been focusing so much on cash flow. It really does come into play. Again, repayment flexibility. So you want to capture those seasonal variations in your cash flow. So you can actually adapt your payments. This is something you can ask about. Can you match them to your cash flow cycles? So for example, payments for a new initiative could increase over a 48-month period as the project itself generates more cash and more cash flow to make the repayment. And are you able to easily extend your repayment terms? Again, just in case, you never know what circumstance might happen down the road. And I would be remiss if I didn't ask you to please make sure you submit your financial information on time. It shows transparency, and that can go a really long way to ensure you're approved the next time you have a project you want to finance. Our research indicates that women entrepreneurs are more reluctant than men to borrow money and more likely to try and finance their growth projects by saving it from cash. So I want to go over just a few things to avoid. The first one is borrowing too late. So you may find yourself needing to borrow money quickly, and in that case, you're doing it from a position where you feel uncomfortable. Now, when there's a sense of urgency, that can also red flag indicate to a banker that there was poor planning, poor cash flow. So a better way to go is to visit your banker and discuss your plans and your financing needs early in your thinking process. That way you can line up the funding before you need it. And remember, I mentioned they've got great advice. Use them as a resource. Another one is borrowing too little. Now, I'm going to be the first to say you want to be careful about how much debt you take on, and that's not exactly what I'm getting at. But you also want to make sure that you can make your payments. But the flip side to that is underestimating how much a project will cost can leave your business facing a serious cash crunch when it comes to implementation. And I mentioned it before, but draft an optimistic and a pessimistic forecast, and that way you can actually know how much you think you're going to need to implement fully. And the last tip that I want to give, paying back your loan too fast. Our research indicates that women are more likely to pay back their loans early in an effort to become debt-free. Again, it's important to reduce your debt, and I absolutely get that. But you also need to be careful not to hurt your company's growth prospects. Reducing your debt too quickly could leave you short of cash. And Candace, you raise a really great point. Most people tend to underestimate how much the total project is going to cost. So I definitely recommend you compare your projected rate of return on the investment of cash relative to how much interest you're paying, and really figure out if you're saving or not by paying down your loan faster than required. And if you expect to earn more on investing the money in your business, well, consider slowing down your repayment pace to free up that money to fund your growth. Now, I'm rather excited to say BDC has a number of products and services available, as Franca mentioned. And for entrepreneurs who need smaller loans, you can actually apply online for up to $100,000. Obviously, conditions apply, but there's no application fee, and the application is done 100% online. It's pretty quick and easy to get through. Now, I hope the tips that I've shared will help you prepare what we call a winning loan proposal. And you can learn more about what a banker expects from entrepreneurs by downloading our free ebook as well. It's available on bdc.ca. There we've got so many tools available. And in my profile here on Hopin, you've got my LinkedIn, but I'll also put my contact information in the chat, because if there's anything that you're looking for, I'd probably be able to find it quickly and help you out with that. Now, you heard from my colleagues before, from both FedDev and also from OffSME, that similar to them, BDC's been looking at how to be a better customer for Canadian entrepreneurs. So BDC also has a supplier diversity program. This ensures that our suppliers are as diverse as our clients. Businesses can now add their profiles to our online supplier database to give us more visibility to the full range of options available. As an organization, we're already seeing the many benefits. We've improved innovation, quality through our access to suppliers that we might not otherwise have identified. And our supplier pool is more reflective of the fabric of our country. Most importantly, we're providing opportunities to help businesses grow. So please visit bdc.ca and go to the I Am a Supplier section. Again, I'll add that into the chat as well. Now, at BDC, I haven't even talked about us really. Our mission is to help create and develop Canadian businesses by offering financing, capital, and advisory services, mostly to small and medium-sized enterprises in Canada. We also provide business loans and advice to help thousands of entrepreneurs just like you manage their finances. If you think we can help you, please don't hesitate to give BDC a call. Visit us online. There's tons of resources. Again, the section is called the Entrepreneur's Toolkit, and I'll include my contact information in the chat. Thank you again for having me today. Happy to answer any questions. I know we've got a few minutes left, so I will stop sharing now. And if there's any other questions, please don't hesitate to ask. Oh, thank you, Anne. I appreciate that. So here's my info here. I'll pop that into, oh, you're welcome, Dwania. I'll pop that into the Reckon one. Is there a corporate tax class that I can recommend? Ooh, actually, you know what I would suggest? Make sure you're connecting with the CPA. There is actually an association for Canada of chartered professional accountants. They would be the best people to be able to give you the exact answer to your question on that one. I do find that's a little bit outside the scope of what we do, but that's definitely one space to consider for sure. No problem, man. I know that wasn't a specific answer, but CPA is definitely the way to go for that. Any other questions? I gave you so much information. I will leave that one with Dwania to answer, whether or not there's a video copy of this presentation. But certainly if there's any of the resources, I'll make sure to get those into the chat in our booth as well. Amazing. Well, if there's any other questions, I'm at the booth. I'll be there all afternoon, so you can come check in anytime. And we will be live on stage at 2:15. You'll be seeing Dwania and I there as well. All right. Thanks so much, everybody. Have a great afternoon.